Our last mini lecture for the chapter will cover Learning Outcomes 11-4 and 11-5. Now we've already covered part of 11-4 because when we talked about the issuance of common stock, we also discussed the issuance of preferred stock, which is handled exactly the same way in terms of journal entries. But let's review what preferred stock is. Preferred stock is a special form of stock, and it differs from common stock in a few ways. Preferred stock holders have different voting rights. They may range from no voting rights to super voting rights. Secondly, the dividends on preferred stock are at a fixed rate. It might be specified as a certain amount per share, or it might be a percent of a par value. And thirdly, preferred stock carries priority over common stock if the corporation distributes assets upon liquidation, or if it distributes dividends. And we're going to be talking about that dividend preference today. We said that preferred stock issuance is handled in the same way. To get the cash received, we multiply the number of shares times the market price. We credit to the preferred stock account the number of shares issued times the par value per share, and anything additional over par value goes into the additional paid in capital account. Preferred stock can be purchased back, in other words, treasury stock, just like common stock, except instead of calling it preferred treasury stock, we call that a preferred stock redemption. Okay, let's hop to the most important part here that we'd like to deal with, and that's preferred stock dividends. Preferred stock offers dividend preferences. Preferred stockholders get their dividends first, but there's two types of dividend preferences. The first one is called the current dividend preference, and that requires that preferred dividends be paid before paying any dividends to holders of common stock. Now in our example here, which is like the example on page 521, there is preferred stock outstanding, 2,000 shares. That preferred stock is 6% preferred stock. That means that each time a dividend is declared, we would multiply that 6% times the par value to determine what the dividend per share is. And in this case, it would be $1.20 per share dividend. Let me adjust the light there. So each share would get $1.20. The par value times the percent. And of course there are 2,000 shares outstanding, so $1.20 times 2,000 shares would be $2,400 distributed to preferred stockholders. There's also common stock outstanding, a par value of 10 each, and there's 5,600 shares outstanding. Now, to give you an example of the current dividend preference, let's say in the year 2015, a total of $8,000 in dividends is declared. Of that, the preferred stockholders would get $2,400. Remember, there were 2,000 shares outstanding, a $20 par value each, and it's 6% preferred stock, which means they get 6% of par, or $1.20 per share. Well, if the preferred stockholders get $2,400 of the $8,000, then the common stockholders get whatever's left, or $5,600. In 2016, a total of $10,000 of dividends were declared, so again the preferred stockholders would get $2,400, and the common stockholders would get whatever's left, or $10,000 minus $2,400 equals $7,600. Now, if the preferred stockholders also have the cumulative dividend preference, that means that if all or part of the current dividend is not paid in full, then the cumulative unpaid amount, which is called dividends in arrears, must be paid before any future common dividends can be paid. So in our example here in 2015, 2 years of dividends are in arrears. In other words, no preferred dividends were distributed in 2013 and 2014. So first, dividends for those years must be paid to the preferred stockholders. Then dividends for the current year, 2015, must be paid. Then finally, the common stockholders get what's left. So when we just calculated the amount of dividends per year, we said it's 2,000 shares times $20 par value times 6%, or 2,400. So that means the dividends in arrears that are owed to preferred stockholders would be 4,800 here, because 2 years times 2,400 per year is 4,800. The preferred stockholders would also get the current year's dividends. In other words, the preferred stockholders would get $7,200 of the $8,000. So common stockholders would get what's left, only $800. In the next year, now that there are no dividends in arrears, the current stock or the preferred stockholders would get just their regular $2,400. So if $10,000 in dividends were declared in all, and preferred stockholders receive $2,400, the common stockholders gets what's left, or $7,600. And there's a problem in your Blackboard Chapter 11 folder which demonstrates this. Let's turn to page 7 of 7 in our notes. Just a review on what retained earnings represents. It's the total earnings that have been retained in the business rather than being distributed to stockholders. Think of retained earnings as the amount of equity that the company itself has generated for stockholders through profitable operations, but has not yet been distributed to them. It's the earnings or net income that has been kept in the company. Now let's take a look at the statement of stockholders' equity. Now we've never done one of these, but we just want to show you what this looks like. I have to tip it up a bit so that we don't get any glare here, or adjust this down here perhaps. There we go. Okay. With the statement of stockholders' equity, we show each of the stockholders' equity accounts, what they were at the beginning of the period, and then any activity, and then what their total is. So for example, we began the period with $270,000 in preferred stock. We bought back or redeemed $120,000, so our balance is $150. Let's see, here's retained earnings. We started with retained earnings balance of $129,773,000. We added in the net income for this period. We subtract out the dividends, and our remaining balance is $190,733,000. So it gives you a little bit more comprehensive picture. There we go. It gives you a little more comprehensive picture of what's going on in each individual stockholders' equity account. And that's the statement of stockholders' equity. Okay, that can be found on page 522 in your text. Finally, in LO, or Learning Outcome 11-5, there are 3 metrics or ratios that they're introducing in this chapter, and we will see them again in chapter 13. The first is earnings per share, and this calculation is usually shown on the face of the income statement. What it basically calculates is how much of net income has been generated per each share of common stock. So this really should say earnings per common share. We take the net income and subtract out the dividends that are due to the preferred stockholders, and that gives you the net income that's left over for the common stockholders. We then divide by the average number of common shares outstanding. That tells you the amount of net income generated for each share of common stock, and the higher ratio, the greater the profitability, and the more likely you are to get dividends. The return on equity ratio takes the net income and again subtracts out the preferred dividends, just like in the earnings per share, but this time we divide by the average common stockholders' equity in dollars. So this tells you how good management has been at taking the investment of the stockholders and generating net income for the common stockholders. A higher ratio means stockholders are likely to enjoy greater returns. And then finally, the price-earnings ratio. We take the current stock price per share and divide by the earnings per share calculation, and that tells you how many more times the current year's earnings investors are willing to pay for a company's common stock. A higher number means investors anticipate an improvement in the company's future earnings. In other words, they have confidence in the company and its business model. And that's the end of Chapter 11. Remember, there is a problem in your Blackboard Chapter 11 folder dealing with preferred stock dividends.